Hello and welcome to the third lecture in our Introduction to Financial Accounting series. This series is intended for accounting students undertaking introductory financial accounting courses or for those who are seeking a fast-packed refresher of key financial accounting concepts and principles. In this session we will explore two major accounting frameworks, International Financial Reporting Standards, IFRS, and Irish and UK Generally Accepted Accounting Principles, GAAP. Essentially, these frameworks provide the rules under which financial statements are compiled and presented, dictate the format of profit and loss account statements and balance sheets and all other related notes and accompanying information. Our focus will be on understanding the purpose and structure of these frameworks and identifying some of their similarities and differences. Learning objectives. Let's start with our learning objectives for today. By the end of this lecture, you should be able to define IFRS and Irish and UK GAAP and understand their purpose. Identify some similarities and differences between the two frameworks. Explain the importance of these frameworks in financial reporting. Importance of regulatory frameworks. Why do we need regulatory frameworks in accounting? Regulatory frameworks ensure that financial statements are consistent, comparable, and reliable. They provide a common language that allows stakeholders, investors, regulators, and businesses to communicate effectively. In this context, two major players are the International Accounting Standards Board, IASB, which develops IFRS, and the Financial Reporting Council, FRC, responsible for Irish and UK GAAP. These organizations aim to provide guidance and standardization while balancing the needs of local and global economies. Both organizations publish individual accounting standards that mandate how assets and liabilities and transactions are presented and disclosed in financial statements. Overview of IFRS. Let's first dive into IFRS. Developed by the IASB, IFRS is a set of principles-based accounting standards adopted by over 140 countries. Its primary goal is to promote global consistency, transparency, and accountability in financial reporting. The IFRS framework emphasizes flexibility and professional judgment, which makes it adaptable to a wide range of industries and economic contexts. Examples of key standards include IFRS 15 for revenue recognition and IFRS 16 for leases. Overview of Irish and UK GAAP. Now, let's look at Irish and UK GAAP. This framework is developed and maintained by the FRC. It is primarily used by entities in Ireland and the UK that are not required to report under IFRS. Irish and UK GAAP is built around Financial Reporting Standards, FRS, with key documents including FRS 102 for medium and large entities and FRS 105 for micro entities. Unlike IFRS, which is globally focused, Irish and UK GAAP is tailored to local business environments, making it particularly relevant for small and medium-sized enterprises, SMEs. Some differences between IFRS and Irish and UK GAAP. Understanding the differences between IFRS and Irish and UK GAAP is essential for accountants working across borders. Here's a quick comparison. Principles versus rules. Both frameworks are principles-based, but IFRS tends to provide more detailed guidance for complex transactions. Entity size. While IFRS applies broadly to entities of all sizes, Irish and UK GAAP offers tailored standards like FRS 105 for micro-entities. Revenue recognition. IFRS 15 provides extensive guidance on performance obligations, while FRS 102 adopts a simpler approach. Financial instruments. IFRS 9 includes detailed rules for classification and measurement, whereas Irish and UK GAAP simplifies this for basic instruments. Convergence efforts. Harmonisation between IFRS and local GAAP frameworks has been an ongoing effort. For example, FRS 102 incorporates principles from IFRS, particularly in areas like financial instruments and revenue recognition. However, challenges remain. Global convergence must account for differences in legal systems, economic conditions, and the needs of smaller entities. The goal is to strike a balance between consistency and relevance. Benefits of harmonisation. Why does harmonisation matter? For businesses, it simplifies the preparation of financial statements across multiple jurisdictions, reducing costs. For investors, it enhances comparability, enabling better decision-making. And for regulators, it strengthens oversight and transparency. In essence, a more harmonized approach improves trust and efficiency in global financial markets. Key takeaways. In summary, IFRS and Irish and UK GAAP are essential frameworks for standardized financial reporting. Understanding their similarities and differences is crucial for accountants. Harmonization efforts aim to improve global consistency while respecting local needs. Further reading and resources. For more information, visit the IFRS website. Explore FRC's guidance. Thank you for joining today's lecture, and we hope you found this session useful. Please like and subscribe to our channel for more content like this.